What's up, YouTube? So we are going to go through Wolfspeed, ticker symbol WOLF. What we're going to do, so this particular stock was brought to us by a current subscriber. He asked us to go over Wolfspeed real quick, and that is what we're going to do. But as we can see right here on our earnings per share, Wolfspeed is not a profitable company right now, and even forward looking, we're not seeing profits. And we do have a short interest of 12.5%, but on a non-profitable company, that's not very uncommon. So over here to the earnings last quarter, which was released October 30th, they beat on their EPS but missed on their revenue. And on this next quarter, which comes out next week, analysts are expecting, well, the analysts have revised their EPS expectations higher for the most part. So we can come down here, we can see our EPS expectations from analysts forward looking. We can see even forward looking into a year, we're a good clip away from actually breaching into positive territory for earnings per share. So when we go over to the financials, one of the things we want to understand is now we know it's at least going to be 12 months, and obviously based on the trend and trajectory of the growth of the EPS that analysts are forecasting, it's going to be a couple of years, maybe 2, maybe even 3 years. You're figuring maybe out to here potentially before the company possibly starts seeing some profits. So we want to make sure a company is able to maybe pull in some free cash flow and also has enough cash to sustain non-profitability for a couple of years. So what Wolfspeed here does, here's their featured products. They've got 3 different sectors here that they have of products. I didn't look too deep into what products they do, but it's like semiconductor based stuff. So they've got like diodes here. I think this is like, I don't know, some sort of module that they also offer, but they're involved in a few different industries. They've got automotive, industrial, and renewable energy. So over here to our financial spreadsheet, we're going to take a look at the charts and see how this thing is trending. So we got a revenue, gross profit, net income, all three. In 2015 to 2018 there, not terrible. It was obviously revenues were declining, net income not declining, not ideal, but obviously it was pulling in a lot more revenues back then. And now revenues are basically cut in half. Net income is trending lower rapidly, and we can see this over here. There's a big decline in net income here. So that is something we maybe want to take a peek at to see if that's like a one-time deal or if that's going to be potentially ongoing. And we can see margins too are slipping rapidly. Last quarter was 12.5% margins, and historically, I would say their average is 30% margins. So that is not good. So come down here to, let's take a look at their balance sheet. We got cash to short-term debt, plenty of cash to cover their short-term debt. They're sitting at $3.3 billion in cash and about $750 million in short-term debt. So pretty good right there. But cash to debt, what they did, as we can see back in 2022, we lined these two up. Company had way more cash. And actually, if you look at that comparison, that cash to short-term debt there, in my opinion, is pretty good. And then over here, they must have issued a lot of debt, a lot of notes. And what they did, that issuance of debt, they carried over to their balance sheet, kind of, which is fine, obviously, but usually you want to use that cash for a particular reason, unless they're forecasting the fact that they're going to try and use that cash to cover their negative earnings per share. So they're going to use that. They borrowed money. They're going to use that money to cover their negative earnings. So obviously they're going to be burning through money, and they issued all that debt. So they're going to burn through that's probably their idea, is to burn through all that money, or not their idea, but obviously that's what their plan is to utilize that debt that they issued to cover their negative earnings that they have. So anyway, we can see debt continues to climb pretty rapidly. We can see cash is not rising as quickly as debts. And then we come over to here, we see our free cash flows. Free cash flows in the red here, negative $1,500 a year. And again, we've got $3.3 billion minus $750 million. That leaves you with about what, 2.5, $2.6 billion in cash. So you've got about a year and some change, maybe 2 years, uh, probably less than 2 years of cash left over. And obviously these are growing pretty quickly. Their free cash flows are growing pretty quickly. Our debts continue to grow as well. So I would give them probably a year and a couple months before they're out of cash, before they will have to likely raise more capital if they want to stay in business. But obviously, at some point, people are going to stop lending them money as they are. If if you're a bank and this company came to you like, hey, I want to borrow another $2 billion, and they show you these kinds of financials, are you going to want to give them money? And if you do, what kind of interest rate are you going to tack onto that? So that's a question, if you were the bank or whoever you are, put yourself in that shoes. Is this a company you want to invest your money into for the long run? Now what we can do is come over to their most recent 10Q that was released in October, and we can see break down their numbers maybe a little bit more beyond what the financial statement or beyond what that spreadsheet was showing us. We've got $3.3 billion in cash here, and year over year, actually, it's only just quarter over from last quarter, they grew their cash position by about $400 million. So what we do is we take our cash minus our short-term debt, leaves us with about $2.5 billion left over. We'll come down to our cash flows, and it's kind of telling us a different story than what we were actually seeing. So we got our $1.23 million loss from continuing operations, and then we take our $113 million loss from cash from operations, add that into our capital expenditure cost here. So you're sitting at about negative $555 million. So we take a text here. So we got a negative $555 million loss on our total, CapEx plus cash from operations. And we've got $2.5 billion in cash. And this $555 million loss is going to be multiplied by 4 because this is only over the course of 3 months, as we can see up here. This is a 3-month period. So multiply that by 4. Basically, we're just going to round to it. We're going to call it $2.2 billion. So you take $2.2 billion minus your $2.5 billion in cash, you're left with about $300 million left over. So that gives you about 1 year and maybe a month cash until you're out of money. So that kind of gives you an idea of where this business could potentially be headed. And if they cannot turn a profit, and that's the other thing too, is we want to look at their income statement. And we come over here to their income statement. And this was another red flag, obviously, is we can see revenues are flat. Obviously, that's not good either. You're not seeing revenue growth. But on top of it, look at your cost of revenues. It went from $122 million to $173 million in just 1 quarter or 1 year, year over year change. Your cost of revenues increased significantly. Your revenues did not. So obviously, this company, from a profitable standpoint, is a long ways away. Doesn't mean they can't turn a profit in the future. Doesn't mean this company can't pull its way out of debt and start making and become a really profitable company in the future. But based on financials that we are looking at right now, this is a company that I personally would not stay, I would stay away from. And honestly, if it was just me looking at this company, I would have came right down here to the balance sheet. I would have seen this and I said, okay, nope. And then I would have seen that the balance sheet was not great. And then I would have seen free cash flows are continuing to decline rapidly. For me, I would have been like, this company's got way too much work to do before I want to put my money into it. I would prefer to, if this chart was going the opposite direction and this was our balance sheet, I might consider I might actually look deeper into it, but it's not. It's burning through cash rapidly, and just based on the financials real quick, financials do not look very good whatsoever on this business. But we can take a real quick peek at the stock chart just to see how the stock is performing. And it is doing exactly what you would expect on a company that is not making money. And we peaked out at $142 per share, which is just crazy. And then we've just been locked in a downtrend, testing support down here at about $28 per share. And we bounced up to this purple line and are coming through back down to support very quickly. And my guess is we're going to see a break of support. And my also guess is $0 in a bankruptcy is probably in the future of this company. Obviously, things can change, but based on the trajectory of the financials right now, I think that is right where Wolfspeed is currently headed. That is it for Wolfspeed. If this video was helpful for you and you found value in it, drop a like, subscribe. Also, if there's any stocks that you want analyzed or financials, a second opinion on, whatever, drop it in the description down below and I will add it to the list. Thanks for watching.